Good morning, everyone, and welcome to this webinar on the IMAP awards process for 2023. This is an opportunity for us to talk a little about the awards process, the categories, including the new category we've introduced this year, and the judging process. More importantly, of course, it's an opportunity for you to ask questions of the judges. And I'm delighted today to be joined by two of our judges, David McDonald and Brad Matthews, who will talk about the judging process in much more detail. And then we'll be joined by two of our sponsors for the awards, Leah Willis from Australian Ethical, who are sponsoring the responsible investing category, and our longtime sponsor, BlackRock, where James Waterworth will be talking about the process that they use to put the finalists of the licensee category through Aladdin, BlackRock's industrial strength tool for portfolio analysis, and the values which we as judges get out of that. So the agenda today will be, as I say, we'll have a couple of judges talking about the process. Then I'll hand over to Leah and to James. So, of course, if you want to ask a question, just use the questions at the bottom. It's a small webinar today, so we encourage you to ask questions about the process, about the criteria, and anything which might be relevant to you. So let's kick off first of all by introducing the judging panel. We're delighted this year to have been joined by our judges with considerable experience both in this process, but more importantly in portfolio management and the assessment of managed account programs. Managed accounts are becoming a critical part of the way in which advice is being reshaped in a post-FOFA and shortly post-quality of advice review world, a world in which free, good advice is going to be widely available from institutions and industry funds, and in which managed accounts are going to be one of the key tools by which advisors present their services as part of their, in an implemented way. So our judges this year are Brad Matthews, David McDonald, who are both joining us today, Dominic McCormick, who will be known to many of you as a long-time consultant and portfolio manager, Nigel Douglas from Douglas Funds Consulting, Rob De Silva from SQM, and I chair the panel. So the categories, it's now my pleasure to hand over to David McDonald, from the investment specialist at IMAP, to talk a little about the categories and then to talk about the criteria that we use to assess entrants. David, over to you.
Thanks, Toby, and good morning, everyone. Yes, so I will just briefly touch on some of the categories for the awards and then go through an overview of the process. Sorry, can we go back one slide, Toby? Yeah, so I'll leave out the innovation category because Toby's going to talk about that in a little bit more detail later on. Next, you can see we have a category for ESG portfolios. This is something we introduced last year, and we know ESG is becoming much more of a focus for clients and advisors. This is the second year we've had this category, which, as Toby mentioned, is sponsored by Australian Ethical, and Leah will talk a bit more later on about the importance of ESG. We then have two categories for the overall managed account portfolios, the licensee category, which we've had for a long time now. And this year we are introducing a separate category for boutique licensees. This is to give smaller outfits a chance perhaps to compete against some of the big firms that also enter the awards. So the boutique award is open to firms that have a managed account program who have 20 or fewer advisors, and funds under advice of less than $750 million. Now, the asset class awards, I guess, are self-explanatory. Obviously, we've got awards there for people running Australian equities portfolios, small cap Aussie equities, international equities, and multi-asset portfolios and Australian fixed income. We can have the next slide. Thank you, Toby. So the awards are judged on a mix of qualitative and quantitative factors. And we look at the traditional things such as process, people. We do look at track record of performance and also take fees into account. As a guide, last year, you can see there the weightings to the criteria. We had 70% applied to the qualitative criteria and 30% for quantitative. That'll be discussed by the judges, and we'll come up with final numbers for how that'll be judged this year. And all the entrants are judged against a peer group of other entrants in their category in the awards. Now, I'll just talk briefly about the client collateral, which is one of the qualitative factors. I mean, we think communication is very important. That's something that comes up often in our discussion with advisors. So we do ask that people send in examples of client materials, such as monthly or quarterly reports, their macro outlooks, that type of things. So we're looking to see how easy is it for a client to understand what's happened to the portfolio that you're running for them. Why are you making the changes you've been making? If it's an Aussie equity portfolio, what sectors do you prefer? Why have you switched into certain sectors? If it's multi-asset, have you been selling bonds and putting money into equities? If so, why? Will I be able to read that and understand what's happening with my money, how it's performing, and why it's allocated where it's been allocated? I'll now hand over to Brad, who'll go through some of the other judging aspects.
Thanks, David. So, yeah, look, in terms of the qualitative factors, they're listed on the screen there. So with philosophy, I guess we're not looking to judge the philosophy and determine whether we agree with it or not, but what we're looking for in the submissions is a well-articulated philosophy that can be understood, and also the areas of that philosophy that may differentiate the manager from the rest of the universe, and make it clear how they see that they can add value through the implementation of that philosophy. So again, we're not trying to align it with our own beliefs, but it's really about how well it's described and how well it can be linked back to the investment strategy. Similarly, with the investment process, we're looking for the ability to explain the process, but I think with process, it's also important that in describing the process, you're able to demonstrate how the process could prevail irrespective of the individuals involved. So that's essentially what the process is. It's a way of managing money and an instruction on how to do that. And that needs to stand up in its own right. And I guess we're looking for that rigor in the description of the process. In terms of people, probably no surprises. The judging criteria there is looking at the quality and quantity of people involved and their background, and the extent to which the team sort of managing the managed account is fit for purpose in terms of what they're looking to achieve through that management. And David has touched on the client collateral, which has got a component of the judging in its own right, yeah, certainly one of the more interesting categories to judge, because we do see a lot of variety in different approaches to client communications. So just on the next slide there, Toby, in terms of the quant, so this is where we're measuring the actual track record of the managed account. We are looking at sort of risk-adjusted returns through a Sharpe ratio calculation, and then comparing it to the benchmark within each of the asset classes. And we are looking to run a 3-year track record. Appreciate there may be some managed accounts that haven't been around for 3 years, and we will try and adjust for that. But it's probably going to be hard to get a really good score on the quant side with a short track record. But we will try and be fair in the way that we assess that. The other part of the quantitative assessment is the fees. So We are looking at the model manager fee, and obviously the cheaper the better to a large degree in the way that's assessed in terms of the value back to the end investor. And just moving on to the next slide there, just a couple of tips, I guess, from my perspective in terms of putting the submissions together. It's certainly the quality of the response in the submission process that's important, not so much the quantity of material. So the more articulate it can be and the more plain English it is, but the better. Certainly loading up the responses with material that's of only sort of partial relevance is probably not something that we're looking for. It may be tempting to take large chunks of what's already in a FSC questionnaire, for example, and put that into the response. In most cases, that doesn't work. There may be some cases where it's very relevant, but I would try and avoid that and encourage everyone to take the time to submit the material that's relevant to the questions being asked. Definitely include examples of client collateral. And I think whether you're talking about philosophy or process, really focus on what makes you different to other managed accounts, what's unique to your investment process or your philosophy that sets you apart from others. For the licensee category, so where a managed account's being positioned specifically for a licensee or a firm, I think the big difference there in terms of what we're looking for is why that solution is relevant for that advice, practice, and process. So what is the linkage between the practices, advice, process and the investment proposition that's developed through the managed account? If we're not able to get an appreciation of that, then you do ask the question, why isn't that practice just buying something off the shelf? So really the essence of the licensee category is why is that managed account fit for purpose for that firm or group? So hopefully that is helpful. I'll just pass back to Toby to talk through the innovation category.
Thanks very much, Brad and David. And look, just to echo Brad's point, that we're looking in the responses that we get back, the entries that we get back, for precision of description rather than the FSC. So let's talk a little about innovation. I mean, managed accounts over the last 5 to 10 years has been an area of significant innovation. It's been an iterative process, and this category isn't one which we're always able to award, but it's important to us. It's important to be able to try and reflect the efforts that managed account providers of all sorts, this is platforms, the portfolio managers, the asset consultants, the advice firms, to try and, I guess, award or reward those people who are genuinely trying to improve outcomes for clients through innovation in their managed account service offer. The criteria for this are extremely broad. Explain how what it is you do is innovative. Where does the innovation arise? And secondly, explain the way in which this produces better outcomes for clients. So it really is that broad. The entry form has those two questions on it. So now look, it's an opportunity to take any further questions from the audience. If there are any, fire them up through the Q&A for David, Brad, or myself. There's one question here, which is, can we provide a little more detail about the boutique category? This is a new category for us this year, and it's an opportunity to try and showcase the benefits which smaller advice businesses bring to their use of managed accounts and their ability to service clients. It's an opportunity for us to showcase the way in which smaller businesses are able to, if you like, integrate the resources of others into their managed account service offer for for their advice clients. Brad, is there anything you'd like to add, or David, to this, to the way we're thinking about this category?
Yeah, look, I think it's sort of evolved out of the more general diversified or multi-asset category we've had previously, and a sense that it was probably very difficult to compare a small firm-based managed account to a very large licensee offering, where the large manager is always going to score better on resources and probably process as well. So it wasn't a like-for-like comparison, and particularly coming back to that point about solutions that are being evolved specifically for the purpose of a small group of advisors, and why that works for them, and what's unique about their philosophy. I think we can capture that better in a boutique type category.
It's also a reflection, I think, of the structural changes in the advice world generally, that we've gone from being an industry characterized by very large organizations that do everything internally to a profession characterized by an outsourcing model, the ability for an organization to harness the knowledge and capabilities of other organizations in crafting their own service offer. And the boutique category really does reflect that. As ESG and responsible investing was a new opportunity to reflect evolution last year, this is a way of us reflecting evolution in both advice and the use of managed accounts. There are a couple of other questions here. Let me just pull those up. Why is the Sharpe ratio considered and not Jensen's alpha? This is a bit technical for me. So Brad, I don't know whether you want to express a view on this.
Yeah, look, it's a good question. I think Sharpe ratios more broadly used and understood. I think when you're comparing the Sharpe ratio to the Sharpe ratio of the index that you're benchmarked against, it's a fair enough comparison. But yeah, look, I think if anyone wants to send through a detailed critique of why one is better than the other, happy to look at it.
Yep. Look, both the awards process and the judging process has been one which over the last 4 years that we've run these, we have evolved. There's a question from Andrew. Funds are assessed on a 70% qual, 30% quantitative basis. Why is the performance of a fund given such a small weighting? I guess in our this is partly a reflection of the short history that so many portfolios have had, that managed accounts is an emerging part of the advice profession, and also our view that managed accounts are a way of articulating or expressing the advice outcomes. So we've looked to try and recognise organisations who brought good process, good resourcing, good structures, good thinking to the way in which they deliver client outcomes in an unpredictable world. Look, as we see more and more managed accounts with 7 and 10 year track records, we may well find ourselves in a position to adjust those weightings. Brad or David, would you have a view on that?
Yeah, look, I think that's the case. I think it has been our intention to increase the weighting to quant as the track records increase. Yeah. And I would expect that to happen over time.
Yeah. There's a question here on innovation categories and the types of innovations that have been previous winners. We've had a platform win in Praemium for their approach to the delivery of managed accounts and the I guess the comprehensiveness of their offer. We've had an individual advice firm in Elston win for the way in which they managed communications to clients. So those have been two of the innovation winners that I can think of. There wasn't one last year. The first one, Brad, I forget who won it the very first year. So,
yeah, sorry, I can't help you there.
Yeah, that's right. So we've looked. So the answer is we've looked for both technology solutions and the integration of technology into the client communication process. I would anticipate that there'll be other opportunities for and other ways in which innovation is delivered. That's why we've written the criteria in such a broad way.
Yeah, I think Jenny just mentioned Elston was the initial winner, and that was largely based around the technology of the communication, I think.
Yep, that's right. There's a question here. How do you consider the structure of managed accounts and the benefits it provides, specifically the benefits of transparency, tax efficiency, which may only apply to directly held equities when compared to a portfolio of managed funds? So, so I guess that's a question of comparing, for example, because for example, Australian equities, we are comparing both portfolios of direct stocks with portfolios of managed funds or combinations. Look, the particularly tax efficiency is something which is inherent in direct holdings. It's inherent in the managed accounts. Do we place particular weight on that? Not so far.
Yeah, it's certainly not formally measured as a quantitative lens. I think if the way the direct equities are managed, because I think the direct equities have to be managed in a tax effective manner in order for that advantage to be really crystallized. So if that's the case, then I think you make that point in the submission. If that's part of the process, really try and highlight that in the submission process.
Yeah. That's absolutely right. Yep, that's an excellent point, Brett. Yeah. If that is part of the service offer, and I know for a number of advice firms or a number of portfolios, that is very much part of the service offer in the managed accounts. There's a question here on fees. When you look at fees, do you want only the advisor fee or the total look-through fee, advisor plus underlying managers? You'll see in the entry form that we look for the portfolio management fee. So when this question says advisor, I'm interpreting that as portfolio management fee. So let me make it clear a couple of things which we don't include. We don't include advice to the extent that it is separable from the managed account fee structure. So we don't include advice fees, and we don't include underlying platform fees if the service is run on a platform. It's a messy area because some managed accounts are not run on platforms and administration is part of a rolled out fee. So we ask you for portfolio management fees broken to clients of 100, 250, 500 and $1 million. We arrive at a weighted average portfolio management fee, and we look for the underlying ICRs, and then we combine the portfolio management fee and an underlying ICR into our assessment, which gives somewhat of an advantage to direct to portfolios which include direct stocks, but then that's then only part of the quantitative score, which is only 30%, or has traditionally been only 30% of the total score. Question on the number of entries we've had. Typically we get 50 to 70 entries. Obviously some categories such as fixed interest, for example, there are relatively few providers, and so we get relatively few entries. Some like multi-asset class and Australian equities, there are lots of contenders. So, should all be thinking of the judges and the work they do, because believe me, it's a lot in reading the large categories. And then a question: do we want more than 3 years of track record if available? No, we because when we started, there were 3 years was a bit of a stretch. we settled on 3. I can see us moving that out as more and more funds have longer track records, and we'll probably perhaps wait shorter and longer track records. But for this year, 3 years is enough. The fact that there is a longer track record probably is a qualitative factor rather than won't be taken into account specifically in the quantitative.
Yeah, I think it certainly made that point in the organisation and staffing. If the team has been managing the managed account for a long period, that would be a positive factor.
Yeah. So look, those are the questions. So those are all excellent. Those are all excellent questions. Look, it's now my pleasure to hand over to Leah Willis to speak a little about ESG and responsible investing, and the approach which they take and the reasons they sponsor this category. Leah, over to you.
Thanks so much, Toby, and morning to everyone. And it's nice to be online with Brad and James and David as well. I was just reflecting, Brad, I think you were involved in one of the first RI MDAs that one of the groups we'd been working with for some time launched back in 2021. So, and we just see that the pace around not just MDAs, but models and building RI solutions for clients is gaining momentum all the time. Toby, I might just flick to my one slide for this morning, and I'm not going to take up too much time because there's a bit to move through, but I just wanted to reiterate, we're really supportive of this category. Obviously, we have been doing ethical or responsible investing, and we've actually been called out as a global leader in responsible investing by Morningstar for the last few years, but we've been doing that for over 35 years. So we're really proud, and we have a long history and track record of being able to balance performance and returns and long-term financial security alongside what we would regard as real-world impact in terms of making changes that are necessary for the future of society and people and planet and animals. So really proud to be involved with IMAPs again this year and to be supporting the innovation around responsible investing MDAs. I just wanted to give a really quick sort of overview and context of why this is so important. And I guess I keep reiterating this every time I present in the market for advisors. I think it's incumbent on us to keep reminding advisors why it is so important. So RIA, the Responsible Investing Association of Australasia, come out every year with a benchmark report, and their last report last year noted that responsible investing assets are now $1.5 trillion here in Australia, and that is 43% of all professionally managed assets in Australia. So, almost 1 in 2 investments now are invested with some kind of responsible overlay. Not only that, but we know from the ESG report that we did with Investment Trends last year, and we do each and every year with them, that 42% of investors themselves are now investing with some kind of ESG or responsible overlay, but another 33%, which we call the next wave in that report, are actually looking to invest this way and increasingly are seeking advice from advisors to be able to navigate the options. So that's 75% of investors, and we see that as tremendous investor demand for advisors to be engaging with responsible investing. But even more pleasing was the take-up from advisors that we saw through that report. So we've seen that increasingly advisors are engaging and embracing RI, and it's now up to 1 in 2 advisors that are now providing advice on ESG or responsible investing, and that is up from 1 in 5 a few years ago in that same report. So we think that the momentum, the rise is continuing. We have seen a little bit of a stall in ESG and responsible investing over the last 12 months. Not surprising given where markets have been, and given that we were in the throes of a global energy crisis, and energy stocks are probably one of the most interesting and challenging for responsible investing, given particularly where we are at in terms of the climate emergency and the tremendous transition that not just Australia needs to undertake, but the global, transition that every country, every sector is facing into. So We're pleased to see, though, over the last couple of months that we have seen a bit of a retraction of that. We've seen a bit of a return to norm. But obviously, we're all facing, as investment managers and advisors, we're facing into challenging times, irrespective. I just wanted to point out the four key things on the side of this slide in terms of some of the challenges. And I think this is maybe some of the thought processes that you could put into some of your applications for this award, but also in terms of if you are thinking about developing RI options. There's no doubt that greenwashing is becoming really important. We saw overseas that the EU taxonomy has led the way, but then we also saw the SEC, we saw the ASX, we've seen APRA and now ASIC come out with guidelines around greenwashing. We have actually seen a retraction of a lot of the advertising and promotion from super funds and from investment managers, really sort of cleaning up their act in terms of what they're saying in market, the intentionality of their products, and then, how they're measuring that impact. Is there a proof point? Is there evidence to say or to support those green labels in the marketplace? So that's really important for investors. It's a strong guiding light for investors to be able to help them navigate the options in this space. But also it's something that advisors, if you are looking to develop options in this space, should be thinking about. What is the intentionality of your portfolios? What are you looking to exclude or include? And then how are you going to measure, or what sort of proof points are you going to be able to use to support those claims? We think there is a tremendous momentum around the move from ESG being really the mainstream, the norm, the base case for responsible investing, and moving more towards a values-based approach that takes in more positive, sustainable options and actually is generating real-world outcomes. We think that deeper screening, broader considerations, particularly as I mentioned, the climate emergency. How are we going to face into decarbonisation and some of the thematics, the risks, the challenges, but also the opportunities that come out of things like that. Stock holdings, we're seeing that there's an increase in terms of disclosure and transparency amongst super funds, but not necessarily amongst investment managers to the same extent at this point in time, but certainly increasing regulation around that. And advisors should be thinking about that sort of transparency when they are looking to develop options in this space. And then the business benefits really of engaging, embracing an RI. In that ESG investment trends report, we did see advisors that are engaging in responsible investing, noting that the business benefits of better client engagement, building stronger client rapport, enhancing their value proposition and attracting more clients by offering these solutions were some of the benefits that they noted. So there is some tangible benefits, not just the feel-good factor, not just potentially the investment thesis of investing in a more sustainable way and tapping into some of those global macro trends that we're seeing, but also the benefits to your business around having those client conversations. So that's it from me. I really just wanted to provide our endorsement of this category, encourage everyone to continue the innovation in responsible investing options. And of course, we're always here to help. We have conversations in this space each and every day, and we have 30 years of track record that we can call on to help you navigate some of the challenges and opportunities.
Thanks very much, Leah. And just a few words on the criteria that we apply in this category. It is, as Leah said, a diverse category, and there are diverse approaches. And so one of the things we look for, given that managed accounts are about the implementation of advice solutions for clients, we look for clear exposition of the responsible or ESG approach that's reflected and articulated in the portfolios, and the way in which that's then communicated to clients or reflective of clients' own aspirations. So it's an important category for us. Now, it's my pleasure to hand over to James Waterworth from BlackRock. BlackRock is the original sponsor of the licensee category, and the use of Aladdin has been an important part of the way in which the judges have been able to assess finalists in the licensee category. And James is going to talk to us a little about Aladdin and what it actually shows. So over to you, James.
Fantastic. And Toby, before I sort of kick off, can you see the screen that I'm sharing?
Yep.
Does that come
Yes,
through?
we
Fantastic.
do.
Okay, excellent. So thank you for inviting us to be part of this process, Toby and team. It's a privilege to work with you and see firsthand the quality of investments that licensees are offering to their clients. BlackRock is first and foremost a risk manager, and our risk platform, Aladdin, is one of the largest in the world with over $20 trillion of assets being managed on it. So the risk analysis of Aladdin allows us to understand portfolios at the factor level, and I'll show some slides as I talk. In fact, they are a subset of the slides supplied to the judges last year, so you can really get some insights as to some of the quantitative inputs that the judges will be looking at. So factors are individual risk characteristics that allow us to see what risk is driving the portfolio. And this is particularly important in portfolio construction so that we can understand whether the strategies and managers are working well together. The overall risk is being, and the importance here is that seeing how the overall risk is being managed and that there are no unintended biases or risks within the portfolio. So part of the risk insight produced is to stress test portfolios at the factor level. And this isn't a back test as many stress tests do, but we explicitly take a risk factor or group of risk factors and shock them to stress the portfolio. So the risk engine, taking into consideration correlations across all the risk factors, then allows us to estimate the P&L impact from that particular shock. And you can see some examples here, ASX down 10%, a rate hike in Aussie 10-year, and a historical GFC scenario. So for this examples, we can use to estimate what would happen to a portfolio if, say, for example, US rates increased, Aussie rates decreased, and there was a simultaneous sell-off in European equities. So it's a relatively extreme example, but you get my point as to the what is available. So within the licensee awards, we use Aladdin to analyze all finalist portfolios. It's important here that only our portfolio risk consultants see these portfolios. So there's confidentiality in providing the allocations. Our portfolio analysts analyze the portfolios comparing to asset allocations and industry standard benchmarks and report back to the judges with observations and comments on risk allocations in each portfolio and alignment of the portfolio to objectives. This feeds into the judging process as Brad and David have already sort of gone through. And particularly provides the judges this sort of quant process and considerations and determining category winners. So it's very important also to understand BlackRock is not involved in the judging process, nor are we a contestant in the awards. However, it's obviously our pleasure to be involved and witness the high standards of the best solutions that are offered to wealth clients in Australia via managed accounts. And lastly, and probably most importantly, best of luck.
Thanks very much. Thanks very much, James. Actually, there's one question here. With the Aladdin platform, how does it take into account managers who take an active rebalancing approach, i.e. backward testing the portfolio removes the impact of active managers' ability to rebalance between asset allocations?
So is that the SAA and TAA level? Is that the question there?
Yes, I guess so. I guess yes. I mean, Aladdin's taking a point-in-time approach.
Yeah, that is correct. And obviously it is a quantitative process. So it is sort of a moment in time, but looking historically, they'll be able to see the managers and they'll be part of the qualitative process that Brad and David and co look to. But obviously that would sort of feed through to performance as well. So I guess if the portfolio has materially changed and looks completely different to where it was, say, within the last 3 years, it's obviously important to flag that to the judges as well. But obviously that sort of probably speaks to, this is, in terms of the quantitative, I don't know, Toby, how you do the scoring with regards to that 30%. I'm not suggesting that this is the 30%, but really here we're just trying to provide a level set, where everybody is assessed through the same risk engine at a point in time and providing those additional quantitative points for the judges to use that at their discretion.
Yeah, I think Toby has James just mentioned then, I think probably what that question's getting at would be picked up a lot in looking at process and what the philosophy is and how it's implemented, how they explain that. So if they were able to say during COVID, we did this with the portfolio because it fits with our process, then the judges obviously take that into account in the qualitative as well as what Aladdin.
Yeah, so there's a question from John, the degree to which Aladdin analysis is used in the judging. We use Aladdin as one of the inputs rather than in a formal, X% goes into risk. So it's a way of assessing the degree of riskiness inherent in the portfolio as at the date that we for the data that we take. And I think this year we'll be taking we'll be looking for data for either the 31st of March or the 30th of April as that point in time. And a question then, which is partly for us and partly for you, James, how is the data sourced that feeds into Aladdin? Well, the first answer is the finalists are asked to provide a portfolio, and then James, that's then input into Aladdin, and you can comment on the on how Aladdin interpolates that, interprets that.
Yeah, no, that's a really good question, because it is quite important, because there is a distinction between Australia and other markets in the world, where there's full transparency as it regards to managed funds. So something like an index, obviously, Aladdin can look through to all the underlying securities. And so when we looked at that factor analysis for funds, they are modelled separately by a team, whereby they use sort of factors to sort of understand those strategies within the managed account. So there are, I guess, limitations to this, given the lack of transparency within managed funds, and obviously the judges will be advised that by the portfolio consultant. So if there is a managed account, for example, that's 100% active funds, then that may look, not saying different, but may have a slightly less confidence level versus if someone was 100% index, where there could be full look through to all the underlyings.
Roll on the days when it's compulsory for managers to provide comprehensive holdings. Brad, any comments from you on the use of Aladdin?
Probably just one. I think it may open up also questions rather than answers as well. So particularly once you get to that finalist stage, the ability for judges to go back and ask a question based on some of the findings that come through Aladdin can be quite helpful in getting an understanding of the strategy as well. So there's a stage in the process where I guess we look for interaction with the entrants, and Aladdin's useful in prompting questions at that stage.
Actually, that's a point we haven't made in this presentation.
No.
It's an important one. We invite the finalists then to give us a short presentation on their process and the managed accounts. So Brad's point about questions is we actually have an opportunity to ask those questions live. So one final question here. Still don't understand where the historical data comes from to analyse risk, for example, during COVID. No, it is point in time. It is a point in time risk analysis. So Brad's point about, or David's point about how the portfolio is managed in times of volatility is part of the narrative that an entrant chooses to provide or not, as the case may be.
Yeah, I think also here, Aladdin can do all that work, but I think we don't want to have like a rolling monthly portfolio holdings over the last 3 years. I think that's going to be a huge amount of work for everybody as well. So I think it's it's a quantitative process at a point in time.
It's probably worth saying that a number of the entrants in previous years are actually active users of Aladdin as part of their portfolio management process. All right, look, thank you very much. Well, James, Brad, David, Leah, thank you very much for your participation today. This video is of course recorded and will be available on the IMAP website, and we'd encourage other questions to just come through to David, myself, Jenny, or the support email address, support@imap.asn.au, and we'll do our best to answer them. But as James said, good luck to all of you, and we look forward to your entrance. Thanks very much.
Thank you.
Thanks, Toby.